Welcome back to the Doc versus IRS, episode number 3. In episode 1, we met Dr. Sherman, an ER doc who tried to be a rock star, but sloppy. He tried to deduct hobby losses, and IRS says, hells no. In episode 2, we met Dr. Elbasha, another ER doc who flew to Sudan for continuing education. Aggressive, with substantiation problems. The IRS also says, hells no, and added 20% penalty on top. Today, we crossed the line. Today's patient didn't get penalties, but he got a full code blue, handcuffs, indictment, prison time. Meet Dr. Ryan Ulibarri. He's cosmetic dentist, Fort Collins, Colorado, had a successful dental practice, over $1 million a year in revenue. Married, family man, looks great on paper. So vital signs stable, prognosis about to go south. So in August 2016, Dr. Ulibarri wrote a $50,000 check to a man named Larry Connor for what was sold to him as a tax strategy. 3 trusts and a foundation with the names like Smile High Trust, Title of Liberty Family Trust, Rod of Iron Charitable Trusts, and Faith, Hope, and Trust Foundation. Sounds patriotic, sounds wholesome, right? But it earned him a federal indictment, a guilty plea, and 41 months in federal prison. So let's do a tax dissection of this case. Gloves on. Dr. Ulibarri started his dental practice in 2014, set it up properly as a professional corporation under Colorado law, filed his S Corp tax returns, paid his taxes. So for 2015 and 16, he reported total income of about $1 million and paid roughly $257,000 in federal taxes. Normal dentists and normal taxes. Unremarkable chart so far. But then in August 2016, somebody pitched him an idea. Pay $50,000 once, and you never pay federal income tax on your dental practice again. So now stop. Pause and listen. If anyone, and I mean anyone, ever pitches you a structure where you pay a one-time fee and never owe taxes again on your medical or dental practice income, that's not a tax strategy. That's a confession in court waiting to happen. That's not a treatment plan. That's malpractice with the brochure. But Dr. Ulibarri said, yes, let's do it. So he wired the $50,000, and the next 7 years of his life were a slow motion crime in progress and a series of insomnia that Ambien could not fix. So here's how the scheme worked. I'm going to walk you through it because once you see it, you'll recognize it forever. So promoter set it up 4 entities for Dr. Ulibarri. Entity number 1, Smile High Trusts, the business trust. Number 2, Title of Liberty Family Trust, which is a family trust. Number 3, Rod of Iron Charitable Trust. Number 4, Faith, Hope, and Trust Foundation, which is a private foundation. So these were stacked like a Russian dolls. Each trust named the next trust as its beneficiary. So the income flew downhill. Dental practice to business trusts, to family trusts, to charitable trusts, to foundation. like a waterfall, or for my colleagues, like the cardiovascular system. Income gets pumped from the practice, circulate through the trust, and get reabsorbed back into Ulibarri's pocket, a closed loop. Except instead of oxygen, is tax-free dollars. And here's a magic trick. At each layer, the trust would report income, then immediately wipe it out with a deduction, either by distributing it to the next trust or by claiming it as a charitable donation. So by the time the money got to the foundation, on paper, no tax was owed anywhere, like magic. But here's a kicker: the money never actually left Dr. Ulibarri's control. So he was a trustee of each single trust. And he and his wife were the only signers on every bank account. The foundation paid for his life insurance premiums, his mortgage, his credit card bills, and I'm not making this stuff up, Colorado Rockies season tickets. Then, when he needed money back in his business, the foundation would loan it to the dental practice. Loan, in quotes, from a charity that he controlled to himself. That's not a charitable foundation. That's his personal ATM dressed up as a charity. So now here's a part that should make every doctor listening sit up straight. This is a part I want you to chart. Dr. Ulibarri was warned in October 2016, just 2 months after he bought the scheme. He emailed an actual CPA who was also an attorney, asking whether his new structure was legitimate. And the CPA wrote back, and I want you to hear the exact words from the indictment because they're like poetry. So the CPA said, number one, what a wacky structure, man. Why would you want to do this? And number two, I don't believe a trust would be a valid owner of a dental practice. And then number three, once a client asks me about a trust, I'm having to explain to my clients about why trust is inappropriate and a wacky option presented by someone trying to sell my client something. Those three sentences from a real credential tax professional telling Dr. Ulibarri exactly what he was doing was wrong. So that's actually positive biopsy result in writing signed by a specialist. But Dr. Ulibarri ignored it. He restructured his dental practice anyway. So he closed his bank account at the bank that knew him, opened a new bank account at a different bank that didn't. And he started funneling his income through the trust. Essentially, AMA discharge against medical device from his own tax doctor. And this is a moment a tax mistake becomes a tax crime. So the moment you receive a clear warning from a qualified professional, you proceed anyway. Then the legal team for what you're doing changes from negligence to willfulness. And that willfulness is what the Department of Justice needs to put you in prison. So let me show you what happened on his tax returns. Here are the labs. In 2015 and 16, before the scheme, Dr. Ulibarri reported a total income of about $1 million over those 2-year period and paid about $257,000 in federal income tax. In 2017, the first full year of the scheme, he reported $60,000 in total income, 60 grand, and total tax due, $159. In 2018, he reported $72,000, total tax, cero, nada. 2019, 72,000 again. Total tax, again zero. 2020, $49,000. Total tax, $7,000. In 2021, zero income, yes, zero. In 2022, $25,000 income, total tax, $287. That's not a downward trend. That's a flat line, man. And meanwhile, his dental practice was depositing over $8 million into his bank account during those same years. The total federal income tax he evaded, over $1 million. $1 million, right? So his bank account said millionaire, but his lifestyle said millionaire, but his tax return said barista. In August 2024, the federal grand jury handed down a 6-count indictment. 1 count of tax evasion under Section 7201 for each year from 2017 to 2022. And each count carried up to 5 years in federal prison. And Dr. Ulibarri pleaded guilty. In April 2025, the federal court sentenced him to 41 months. That's 3 years and 5 months in federal prison, plus restitution of every dollar of tax he evaded, plus interest, plus penalties. He lost his dental license to practice. He lost his practice. He lost his commercial building. He lost his home equity tied up in those sham trusts. And when he gets out, he's a convicted felon with a tax fraud conviction. Try to renew dental licensure. Time of death on his career, April 2025. All for $50,000 of bad advice he could have validated with one phone call to any CPA in the state of Colorado. Let me give you 4 hard lessons. These are the ones that matter. So consider this your discharge instructions. Lesson number 1. If a tax strategy sounds like a magic, it's not a strategy, it's a fraud. There's no legal structure in the U.S. Internal Revenue Code that lets a $1 million a year dentist pay 0 federal income tax while continuing to live like a $1 million a year lifestyle. None. That structure does not exist. Anyone who tells you otherwise is selling you a ticket to a federal prison. If a patient walks in claiming a single pill cured cancer, diabetes, male pattern baldness, you would run, right? Same energy. Lesson number 2. Sham trusts are the most common scam targeting healthcare professionals. The IRS calls them abusive trust arrangement, and they're on the IRS Dirty Dozen list every single year. Real trusts have economic substance. They have independent trustees. Grantor relinquish real control. So if you are the trustee of your own trust, the only signer on the trust bank account, and the trust pays your mortgage, that's not a trust. That's you with extra paperwork. Lesson number 3. When a real tax professional tells you something is wacky, listen. Dr. Ulibarri got a written warning from a CPA attorney telling him exactly what he was doing was wrong and illegal. He had it in writing and he ignored it. That email became Exhibit A in his federal indictment. So if you ever get a second opinion from credentialed tax professional and they tell you a structure is wrong, the conversation's over. You don't shop for the third opinion. You don't doctor shop until you find someone who write the prescription, right? You stop. Lesson number 4. Negligence causes penalties, but willfulness costs your freedom. That's a line. Dr. Sherman got disallowed deduction from episode 1. Dr. Albasha from episode number 2 got 20% penalty. Dr. Ulibarri got handcuffs. The difference is willfulness. Knowing what you're doing is wrong and doing it anyway. Once the IRS can prove you knew, the case stops being civil and becomes criminal. So here's my final thoughts. There are real and legal, powerful tax strategies for high income healthcare professionals, like real estate professional status, short term rental loophole, cost segregation, cash balance plan, properly structured S Corp, C Corp, and sometimes captive insurance done right. But every one of them shares a common features. They're documented in the Internal Revenue Code. They have economic substance and they hold up when a federal agent reads them. They're sort of FDA approved, peer reviewed, and evidence based. If a strategy depends on the IRS not noticing, that's not a strategy. It's a stopwatch counting down to your indictment. And Dr. Ulibarri saved roughly $1 million in taxes over 6 years. But he paid for that savings with the 41 month of his life, his license, his reputation, his practice, and millions in restitution. The cost benefit ratio on the trade is the worst I've ever seen in my career. And I've watched patients refusing antibiotics because they read one Reddit post. Don't be Dr. Ulibarri. Pay your taxes, use real strategies, sleep at night. I'm out. And if anyone ever offers you a tax shelter named after a religious symbol, run.